So I'm going to start briefing you. Now, it will come at you in two long format briefings. We have a lot of ground to cover. It distills to a few key points. We have a very hot economy. It's creating a lot of wealth. It's not creating as many jobs, and our housing is too expensive. There's your briefing. Are there any questions? Let's see if we can start unpacking all of that. I have to tell you honestly, I'm going to tell you a true personal feeling in my heart. The message of the index has stayed relatively unchanged over a long period of time. It's essentially what I just told you. And yet, I have a responsibility to tell you all of that year after year after year. And after you've done it for 10 or 20 years, you start to see how things that were imperceptibly changing have actually become substantial changes or even seismic or tectonic shifts. So we'll be unpacking all of that today, and I just want you to know that I'm doing it dutifully as your pathologist. Think of this as the annual physical exam, and I'm going to walk you through all of it in a scrupulous manner. So let's go. Here we go. We're going to talk about employment. Let's talk about our employment trends. Our workforce is 1.7 million people, understand it that way. It was 1.7 million in 2019 when we found ourselves plunged into the pandemic. In the middle of the pandemic, 2023, as we were coming out of the pandemic, our workforce was still 1.7 million people. In 2025, the current index reports a workforce of 1.7 million people. So there it is. The best way to understand us right now, we're flat. We're on a plateau. That, by the way, is new territory for Silicon Valley. We're really used to this. We're really used to steep trajectories. That happens a lot in the valley. We're also used to plunging. We're not at all used to sitting on a plateau such as you see here. So that's really new territory for us. But there we are. Okay, we're fixed at 1.7. Now, every year it's a little more than that or a little less than that. This year we're actually behind 1.7 by 13,000 jobs, but we call that noise in the model. That's actually a small percentage of the whole. Okay, so now you're saying to me, all right, so we've been fixed, and yet the headlines have been screaming at us all year long that there's layoffs happening in the region. And so there is a sense out there, an underlying sense that the economy is unwell and that there's a problem in Silicon Valley. I'd like to unpack that for you. True enough, there are layoffs. They began in during the pandemic. And so there you can see what was happening to us through the pandemic, through 2021. And the layoffs were in the community-based jobs, what we call community infrastructure. And there they were, quite a lot of layoffs. Then something happened. We turned the corner on the pandemic, and then the layoffs became local to the technology sector. And you should know this. Since 2023, 84% of the layoffs that are happening out there that you're reading about in the newspapers, they are coming out of the tech sector. So there's something going on in tech. That, by the way, is the absolute number. We have had 46,000 layoffs in the tech sector, in the economy overall, most of them from tech, since August of 2022 when that started happening. Now, what was the cause of it? There was overhiring during the pandemic. It's straightforward. That's what happened. Remember, the pandemic, we thought, would be a fatal blow to the Silicon Valley economy. We couldn't have been more mistaken. The pandemic for us was a bonanza. Our technology companies were providing all of the platforms, the technologies, the goods, the services, the connectivity that a sheltering world so badly required. So our companies saw that as a new normal, and they scaled up. And I mean, they built new divisions and new organizations around these new demand curves, thinking that would be the new normal. We learned by August of 22 that actually it wasn't the new normal, that those demands would not be staying in place. And so began this new chapter of our evolving history. And that new chapter was to recalibrate, to right size, and to mount an efficiency movement. And that's how the sector has been referring to it. We are now on an efficiency kick. And 4 years later, That's where we are. The efficiency has really kicked in, and I mean that. Visit the campuses. It's a different atmosphere now. Not as many perks. Certainly not as much hiring. And the logic here is that our companies are trying to stay lean, trying to stay nimble, trying to be in a position to pivot as necessary into this new and evolving, changing economy that AI is creating before our very eyes. And so that has been the mindset. Let's be lean, let's be efficient. As a result of 46,000 layoffs, and here we are. Now, 46,000 seems like a big number. I think it's very important to put that number into context. So here's that number, 46,000, as a percentage of the total workforce, 2.7. In other words, you could still refer to that as a marginal effect, 2.7. By the way, at the height of the dot-com collapse at the turn of the century, we lost in one fell swoop 250,000 jobs. So this is nothing of that order of magnitude. That's how we should understand this. If you take that same number, 46,000, and you look at it as a percentage of the tech workforce itself, well, this is what you get. It's less than 10%. So tech is taking a haircut. That's what's going on. Now, there's something else very important that we should also understand. This is our unemployment rate. You can see that it was going down steadily over that long period leading up to the pandemic, to the point where we were in the low 3s, high 2s. And then we spiked up, and our unemployment approached 13, 14% during the pandemic. And then we made up the lost ground. We made it up very quickly to the point where by 2022, we were back where we were when the pandemic began. That's how we should understand this. Then we have some layoffs. Our unemployment today is about 3.8%. Economists will tell you that that is considered to be the functional equivalent of full employment. So something's happening here. Our economy is absorbing the layoffs. And we know this. We know this from surveys and other instruments. So people who have been laid off in the tech sector are nevertheless landing on their feet. They're finding other opportunities, sometimes in the very same company in another division, one that's scaling upwards for AI and those opportunities. Sometimes moving into tech-adjacent fields, moving into fintech, ag tech, ed tech, and related opportunities. So one way to understand the economy is, my gosh, layoffs, and they keep happening. Another way to understand the economy is to say, this must be a very robust place that it can absorb 46,000 layoffs and keep on running. Okay, so that's probably how we need to understand it. However, as people see the layoffs continue to happen, they've been asking this question: are we in a recession? Is Silicon Valley entering a recessionary period? The answer to that is no. Let's understand the definition of a recession. A recession is a technical term, actually. It refers to output, and when the output is negative or declining for several quarters in a row, that is considered a recession. There is nothing of the sort happening in Silicon Valley. We need to be very clear about that. Our output is growing year by year. This, by the way, is our gross domestic product. It has climbed consistently over that long period of time to the point where we've reached $759 billion. By the way, $759 billion, just so you know, we need to put that in context. That would be bigger than almost all of the other 49 states. If Silicon Valley were a country unto itself, we would be 22 in terms of GDP. That's bigger than Belgium, it's bigger than Ireland, it's bigger than all of the South American economies except for Brazil. It's extraordinary, and it's continuing to happen. We'll keep unpacking that today, but that's what we look like from an output standpoint. Now, how about from a profitability standpoint? The efficiency strategy is working. That's all there is to say. Any way you measure it, when you look at profitability, market share, revenues, stock market performance, by any measure, our Silicon Valley tech companies are super performers. And here's one measure of it. This is the market cap. Remember, that's the value of all of the publicly traded companies in Silicon Valley. If you total up their value on the market, it is today 35 trillion. That, as you can see, a record-breaking number. We've never had anything like that. So that's one measure. This 212%, by the way, is the S&P 500. Silicon Valley vastly outperforming the S&P 500. Now, there is a characteristic that we thought we should alert you to. That performance, that extraordinary performance on the markets, is especially driven by what we call the Magnificent Seven. And there they are, Meta, Microsoft, NVIDIA, all the rest. If you were to take the seven out, your number would be 132% growth as opposed to 1,000% growth, as this chart is illustrating. So we have become highly concentrated around fewer and fewer large technology companies, and that's also something we should understand about our ongoing evolution. This is our value added per employee. We'll return to this chart in the second briefing, but as you can see, the most productive workforce anywhere on the planet. We continue to do more, higher output, with fewer and fewer people. It's actually remarkable. Now, we're not just a technology economy. I'm always hastening to point this out. Technology is our driving set of industries, but we're also a regular economy, such as you would observe in any other place on the planet. Technology accounts for, call it 24% of the jobs out there. But that's technology narrowly defined. We have tech in all of the sectors. And so we try to capture that in this other category, which we call business, infrastructure, and services. So if you put all of that together, you could say that tech is, the slice of our pie is around 40%. But the rest is in what we call community infrastructure and services. This is a huge category that captures construction and retail and hospitality and education, and healthcare is here, one of our fastest growing sectors. So we should also understand that Silicon Valley is that kind of economy, both things happening simultaneously and interactively. Now, I wanted to show you, with reference back to the pandemic, how we're doing in terms of the recovery. And for the most part, that we're recovering. This, by the way, is a dotted line showing you the performance of all industries. And so you can see when you put them all together, you have the pandemic set in. There we were. There was a dip. And then we've been flat. Remember I told you flat? That's the way to understand us right now. So that's the performance of all industries amalgamated together, flat for about 4 years running. But some are outperforming that standard and some are underperforming. I thought you'd like to know what some of them are. Well, the big drivers have been healthcare, we mentioned that, also internet information services, or in other words, tech. They've experienced substantial growth coming out of the pandemic. They're ahead of where we were in 2019. Now, here's some others that are recovering. The purple line is nonprofits. And nonprofits took a deep dive during the pandemic. We thought it would be long-lasting. What's interesting is to see that their recovery is quick and impressive, well ahead of where they were. And then the other is arts, entertainment, recreation. Also took a big hit during the pandemic, making a very impressive recovery. That's reassuring. So it's reassuring to know that a variety of segments are performing again as they once did. However, there's some that are not recovering. And there are some industries, as a result of new technologies and structural changes and cultural changes to the way that we organize ourselves for work, they may not recover. And this might be some early indication of that. Accommodation, food services, hospitality, retail, personal services, they are not yet making a recovery. So we should understand our economy in that way. This is just a did you know slide. If I asked you what is the biggest occupation, the most populous occupation in Silicon Valley, the answer is software developers. 1 out of 9 people in Silicon Valley are developers or architects. The next category, if you're curious, is engineers, and that's followed by teachers, my heroes, and then followed by all the rest, including production workers. A lot of people think there's no production in Silicon Valley. That's not exactly true. And we'll talk about that a bit when we're talking about what AI is doing to our region. We should also understand something else about Silicon Valley. Very important here to pause for a moment and point out what maybe is already intuitive. Silicon Valley companies aren't local entities. They are global entities. Our Silicon Valley companies are growing here, as you have seen, but they're growing more outside the region. They're going across the country, and they are growing internationally. We need to understand that. Now, let me show you what those rates look like. The bottom line is what's happening with the Bay Area workforce, and you can see that trend line, and of course, it's positive over time. But the blue line is our leading tech companies adding to their workforce outside of Silicon Valley within the United States, and that is a 46% growth rate. The Bay Area's growth rate is 21% over this 7-year period. The global growth rate is at 65%. So let's understand that. We need to wrap our minds around that. This is a chart showing you the Bay Area's share of the top 20 tech employers. So if you took the top 20 and you counted up their workforce, and you said, what percentage share of your whole global workforce are right here in the Bay Area? The answer is, it was 28% of the US workforce prior to the pandemic. Today, after the dust has settled, it's fallen by 5 points. 23% are here in the Bay Area. 3/4 are somewhere else. Okay, and then we also have, we've charted that for you as share of the U.S. workforce fallen from 15 to 11%. Okay, we want to show you what that looks like when we compare ourselves to some other metropolitan regions that are also using the technology and the innovation formula to grow their economy. So here, over this same period, you should know that San Jose grew by 7%, grew its tech workforce by 7%. San Francisco grew it by 8%. But look at these other places. They are actually growing at a faster rate. They are also adding tech jobs. Now, if I were a booster and we were talking about Silicon Valley as if it were in a competition with other regions, then maybe I would be singing a particular song up here. I want you to know that at Joint Venture, we actually don't consider ourselves boosters. We just consider ourselves clinicians. We're here to just describe the trends and to describe them as accurately as we possibly can. But I'll also tell you we have an opinion, and I will now venture that opinion. We don't see it as a race. We see these outcomes as healthy for our nation. Why wouldn't we want this phenomenon to spread to the other metropolitan regions? Why would we ever think that all of this possibility for prosperity and wealth creation should be localized in one place and only one place? We don't see it that way. Furthermore, we don't see it as a zero-sum game. We don't feel like if an employee's added here, it came at our expense. We don't see that at all. Our vision of the nation is that there can be prosperity across all 49, all 50 states, and that this can be a formula for that kind of growth and prosperity. So to that tune, you can see that we have some high performers, Austin, Dallas, Charlotte, followed by these others. That's happening. It's happening with their own local companies, but it's also happening with companies that are national and global in scale. So then you're wondering, okay, but still, how do we stack up? How are we stacking up? So this is a chart that plots it in 2 dimensions. One is just the concentration of jobs. In other words, when you count up all your tech workers, what is that percentage as a whole? As a percentage of the whole workforce. And then the other one is just looking at the raw number of jobs. So how many tech jobs are there in your local economy? And guess what? This is where we come out. Where you want to be on this chart is up and to the right. And there we are, extremely northeasterly. Still, by the way, those were growth rates that I showed you in the previous charts. Those are not absolute numbers. It's just telling you that those places are growing, but they're starting from a lower starting place. We have been at this level for many, many, many decades, and so of course our growth rates aren't going to be similar. But if you want to know who's furthest northeast, that's us, by far, in terms of concentration or any other measure. Now, we always like to ask about the underlying drivers, and we refer to those things as the innovation engine. And that's the question we'll be asking next. Remember, Silicon Valley and this phenomenon that's made us so successful is really fueled by two things: innovation and entrepreneurship. Those are the two things. So our question at Joint Venture is, can we measure those things objectively? And this is an attempt to do that. So now we're looking under the hood. Here's an objective measure: the number of patents that are coming out of our region on an annual basis. And as you can see, the trend just continually northeastern, and we continue to lead the world in the raw number of patents, but also in the share of patents that our region claims. This, by the way, is a chart showing you the top patent-generating cities in the United States. Well, guess what? 7 of the top 15 are Silicon Valley cities. So from the patent front, we should understand that. This is a chart that we love to show. It shows that finally women are starting to come forward. They are being listed as patent inventors. So in the last reporting period, 36% of patents had at least one woman inventor. We're not telling you this is a good news chart. We're telling you this is an it's about time chart. That's what we're saying. Okay, so progress there. Now let's talk about another objective measure: venture capital. The capital itself is not objective. It's being put at risk, and those risks may not pan out. However, the amount of venture capital that is being put at risk is something that we can measure objectively. We had a crazy year in 2021. In the depths of the pandemic, we generated $95 billion in venture capital. Crazy. And looking back now, venture capitalists, others will tell you, yeah, that was out of whack. There was a lot of FOMO that year. Okay, but now I'm telling you, if you take 21 out of the chart, look what we have. We have this amazing trend going ever upward, and our raw amount this year was $92 billion. The second highest level of venture capital we've ever seen in the region in our long history. I'll also point out one other interesting trend. You see that it's purple and it's green. Green is the amount in Silicon Valley. Purple is San Francisco. And the two regions have emerged as companions. I think of it as a jet engine, a finely tuned jet engine, or a jet aircraft that has two powerful engines, one on either wing. I think that's how we should look at the Bay Area and at our region. So we've reached the point where they're about equally yoked in terms of the venture activity going on there. You'll see later on more startup activity in San Francisco lately. Now, it's also telling that a lot of the venture capital has been concentrated in what we call mega deals. Those are deals that are more than $100 million. This is a new trend. 10 years ago, most of the venture capital was just spread evenly across the landscape, sort of the way you spread manure over your garden, right? Going back about 5-6 years ago, something happened, and most of the venture capital was going into mega deals, really big deals. So more money, but fewer deals, bigger deals. So as of now, we can tell you that 57% of venture capital was going into big mega deals, and several of them. And they're going not only to startups, including small seed fund startups, but they're going into big companies that you've heard of, like Anthropic and like OpenAI, and multiple deals there. These are some of the other top deals that came out of the last calendar year. You should also know that angel investors put together $2 billion in angel investments last year in our region, another record-breaking year. And again, you can see equally weighted between San Francisco and Silicon Valley. Here's your startup activity. It's actually harder to track than you would imagine. Rachel can tell you the lengths that we go to try and track the amount of company formation, seed stage funding. But the picture is ascending upward, as we like to see. There continues to be plenty of startup activity in the region, especially around certain categories. Here's your IPOs. 15 IPOs came out of the region last year. Those were some of the biggest. Those 15 don't constitute a record by any means. Nevertheless, 15 people use that path to liquidity. It's not the only path. It used to be. We used to think of that as the way that the way that a startup should proceed. Today, many startups from their inception are looking to be purchased, acquired, and that's their strategy. And so sure enough, we see a lot of that in the index this year, a lot of M&A activity, and it's being measured in the billions of dollars, and again, splits between San Francisco and Silicon Valley. Everybody knows what a unicorn is, right? A unicorn is a privately held company, not yet public, valued at $1 billion or more. And we chose the term way back when because unicorns are supposedly rare, never to be seen. In just a few years, the term was no longer apt, and so now we start calling them decacorns. Those are, again, private companies that are valued at $10 billion or more. And look, there's our unicorn count right there. 119 in Silicon Valley, 220 in San Francisco. It's the highest concentration on the planet. There are unicorns elsewhere, but that's the highest concentration. We've got almost half of them. Now, there's a look under the hood. So is the engine running? Oh my gosh, yes, I would actually call it white hot. It's white hot. That's how we should understand what's happening. However, it's not translating into jobs, the same kind of job growth that we saw through the teens, right? Instead, here we sit on a plateau. So how do you explain it? Well, one way to explain it is that we're on this efficiency kick in the tech sector, and that's how we're going to roll now. Another way to explain it is to say, well, there are other structural things at play. Perhaps artificial intelligence is one of them. Now, I want to be very clear. We have no data. We have no evidence. As of now, we don't know the impact of AI on employment growth. We don't know. I cannot stand on this stage and tell you that we've measured something. All we know is that AI is happening and that it has the potential to restructure not only our economy, but life on the planet as we know it. And so one question is, well, is that happening here? Are we in the driver's seat for those kinds of outcomes? And so I'd like to spend a moment now talking about artificial intelligence and asking the question, are we an epicenter for that? Well, I told you that there was $92 billion in venture financing. Guess what? 83 of those $92 billions were in AI companies. 83. So it's the largest collection of venture capital for AI anywhere on the planet. That, by the way, is 700% growth over the past 2 years. People are going crazy. Investors, anyway, are going crazy about AI. We're claiming about 76% of all the venture capital in the United States that's going to AI. That's more than a 3/4 share. It's remarkable. I showed you this chart already, right? These are some of the top venture capital deals in our region over the past year. Well, guess what? They were almost exclusively AI. So that, this chart shows you a lot of what you need to know. Here's another way of looking at it. If you take all of the startups, 57% of startups are AI startups, and those startups are claiming about 3/4 of the funding that's out there. This is a census. This is just looking at all of the tech talent in North America. The AI tech talent in North America. Where is it located? Well, it's located across all of these places: Austin, Boston, Atlanta, Chicago, etc. But the highest concentration by far is the Bay Area, and as you can see, that's 75,000 people specifically working on AI. I'm not saying they're tangential to it. I'm not saying they touch it in different ways. I'm saying their job description is specifically AI. They were hired to work on AI problems and opportunities. So 75,000 of those in Silicon Valley. The next highest place would be New York with 45,000. So we're heads above the rest. So that's one way to answer the question. It's the highest concentration. This is interesting to me. It's actually driving a renaissance in chips, and not only their application, but their production. We used to send all of that out of the region. We saw chips as a commodity. We'll do those offshore. Chips are back. They're coming back to Silicon Valley. There's a sense that we should actually keep this closer to the design teams, and it's not good for the country if all of our manufacturing is located outside of our boundaries. And so there's this movement, political, but it's also from a managerial standpoint. Jobs in semiconductor manufacturing are growing, and they're growing at a significant rate. Okay, so that's another measure for us. And then we can look at what's going on with square footage. You've been hearing the stories about how there was all of this human and capital flight out of San Francisco, and one way that was measured was by all of the downtown commercial real estate establishments that were losing major technology companies to other places. And so that's been San Francisco's narrative for a while. AI is changing that, just to be clear. Companies are gobbling up square footage, leases, other activity in San Francisco. And San Francisco's supposed doom loop is becoming a boom loop. That's how we should understand San Francisco right now. And this is also significant. Artificial intelligence is also turning our companies into infrastructure companies. We used to think of our tech companies as pointy-headed people sitting in front of laptop computers doing amazing things. No, actually, if you're an AI company, the biggest part of your investment is going not towards people, but it's going towards equipment. And we're talking specifically about server farms and that kind of infrastructure. So our companies have become infrastructure companies. That's a new development. This is a server farm under construction. They're being located here, but they're also being located at other strategic places, and apparently in outer space. So stay tuned about that. This puts the meat on the bone when I'm telling you they're becoming infrastructure companies. This is showing you the capital expenditures by our big tech companies. So remember, I told you that their human resource expenditures are flat. Their capital expenditures growing at a very high rate, to the point where it's projected to be $637 billion in CapEx over the next year. We're at $562 billion in capital expenditures. New development in our ever-changing technology landscape. Well, people's big question is AI going to take my job? That's the question. We don't have an answer. It's too early. So nothing from us on that subject today. However, we decided to take a crack at it to see if we could come up with anything. So let me show you a number. This is a number, 410,000. There's a team at Princeton that is looking at AI and its potential impact on jobs, and they set out a whole bunch of very highly defined criteria and categories, and then they're trying to make some estimations about what job types are going to be most exposed. And what we mean by that is exposed in a way that your job could be augmented, or your job could be restructured, or your job could be disrupted altogether. And so there are studies that are trying to do that. All of them inconclusive. Again, I want to point out, inconclusive. However, we took the study, the team, and we just placed it on top of the Silicon Valley employment landscape as a template. And when we ran the template, we got that number. So this is just an estimate. It could be way off. We don't know. But we do estimate that about 410,000 jobs are exposed. They are exposed to what AI is doing. We don't know exposed in what way. It could be that the knowledge intensity only increases and that AI amplifies the role of knowledge workers. It could be that AI is introducing augmentation, or it could be that it's introducing the need for restructuring. So where you might have had a team of 7 or 10, that will now be a team of 5 or 7. But still, we don't know exactly how that's going to play out. But we think this is the level of exposure. Then we looked at the income level of people that are most exposed. And this is a new chapter in human history. Every previous technology revolution has actually eliminated jobs at the low end, right? At the unskilled end. It introduced automation. but this is the first revolution in human history where the job types that are most exposed are at the high end in terms of the value-added scale, the high end of the income scale. And so that's what this chart is showing you, that the exposure will be there. It'll be interesting. That's for sure, to see how this is going to play out. Well, this is the big question. Is it a bubble? We need some really good advice on this topic. So we're using a new format at State of the Valley. We're bringing people onto the stage in real time, and we're asking them to share their expertise and their lived experience with us. So I want you to meet right now. I want you to meet Clark Barrett. He's on the faculty at Stanford. Clark, if you'll join me on stage. Clark is running not one but two centers at Stanford that's looking at AI and all of its implications. Clark himself is a computer scientist and a very popular teacher of computer science at Stanford. Thank you for being here. We really appreciate this. Clark, I want to show you this. Here's a census. Lots of people, opinion makers, thought leaders, and they were asked, is this a bubble? And so if you are on the, so here's Bill Gates, for example. Bill Gates thinks, yes, there's a high potential that this is a bubble that will pop. And then on the y-axis, they were asked, well, how concerned are you about that bubble, whether it pops or not? And most people sort themselves out as being less concerned. So let's start with this, Clark. Where are you on the chart? Locate yourself on the chart for us.
Okay, well, as a typical academic, I'm going to make it a little more complicated.
I knew we could count on you for that. Yeah.
So the first thing I want to say is that when it comes to AI, there's a huge level of uncertainty right now. And I think that's the most important thing to digest, is that the only thing certain about this moment is the uncertainty. So it could go wildly one way or it could go wildly another, and we really don't know. But I can tell you what I'm hearing at faculty meetings, conferences, you know, water cooler, all of this stuff, and some of my own opinions. So the answer is yes, it's a bubble in the sense that there's an overinvestment. But this is not that uncommon, right? So it's similar to what happened in the dot-com bubble.
Yes. And when the dust settles, a few players emerge.
So not everyone's going to survive. And in fact, there will probably be a major fallout where many of these investments, don't pan out. So that's the sense that it's a bubble. But something very real is happening, and when the dust settles, it will have changed things significantly.
Okay, so tell us that. What is real that is happening? Not just experimentation, but real application that has the potential for structural changes.
Right. So, I mean, if you look at software, already huge changes because of AI. With the technology we have right now, not looking into the future, things are changing. One way to understand it is certain kinds of tasks that were kind of tedious, you don't need people for those anymore. If you want to write front end, you want to write a website, you want to translate from this to that, this used to require a lot of expertise, a lot of people, you don't need people for that. AI can do it. They can do it today. So I had this interesting conversation with someone the other day. They said, well, that means we're going to lose jobs, right? I said, well, maybe, but we still have civil engineers, even though we know how to build all these things. And they said, yeah, but most civil engineers are building apartment buildings, not Sydney Opera houses. What happens when you can automatically build all the apartment buildings? And I said, well, maybe you just get more Sydney Opera houses, right? So I think something that's really important, and a lot of us believe this, is when you increase the capability, there's an insatiable demand for new technology, for new achievements. It just means you can now do more. And things that used to be unthinkable. For example, I'm going to write a version of this software for every individual, right? That used to be unthinkable. Maybe we can do that with AI now, right? We can tailor the software program to the individual rather than writing one size fits all. These are the kinds of things that could happen. So I don't think it's at all clear that we're going to lose jobs. Now, there is going to be a big disruption. Certain kinds of people who have certain kinds of skills, they're going to need to change those skills. And people who have the skills to work with AI, those are going to be the people that are in demand.
a lot of us experience AI as generative. It's actually generating content, but AI is not limited to that. Would you talk about other aspects of AI and their application?
Sure. I mean, before we had this big generative revolution with ChatGPT, we were already in the midst of a machine learning revolution where people were taking, self-driving cars. That's not based on generative AI. That's based on machine learning. So that is still happening. Things like, being able to translate from one language to another. That was well on its way. And now, I mean, the things you can do are amazing, right? You just click on a button on your AirPods, you can hear someone speaking in another language. It's fantastic. So these things are still happening. All of the machine learning, it's going into, controlling systems, starting to be used even in safety critical systems, right? This is something that I think a lot about in my Center for AI Safety. So yeah, it's not just generative, but these large language models, the thing, ChatGPT, Claude, Gemini, all of these models, they are really driving what's happening in this moment. And the big changes in the software industry in particular are happening because of these models.
One of the great fears, of course, is that AI will be tremendously successful, but it won't translate into human opportunity. And the extreme example is we can imagine a startup company that becomes a unicorn right off the bat, but no employees. It's a founder, a couple people, and an algorithm. Do you see that as literally possible, or is that just out of whack?
I think it is possible, yeah. And maybe, again, the way to think about it is you'll have these smaller, centers of innovation, but there could be a lot more of them, right? And they could be moving more quickly. So we don't really know what that's going to look like, how that's going to pan out.
Yep. I'm just curious, your own, I want to talk about the possibility of dystopia. And if you could imagine a path to such a dystopia, what would that look like? We're not saying that you believe it'll happen, but I mean, just outline that for us. And then, just so you know, I'm going to ask you the other one, which is outline for us the path to no more work, the singularity, and unending human happiness.
All right, sure, sounds good. So I think it's always prudent to be thinking about possible dystopic outcomes, and I think there is real risk here. There are a lot of people running around, very competent, very well-known, really, raising the alarms.
Yes.
And,
right.
The future of humanity is at risk.
Yep.
So I think, there is some risk there. I don't. That's not what I'm worried the most about.
Of course. Yeah.
What I'm worried the most about is misuse. And I think there's a huge potential for misuse of AI. Bad actors using AI to hack into systems. We've already seen this. It lowers the bar for how difficult this is. Using AI to create bioweapons, using AI to direct military attacks, right? These kinds of things, they are already happening. And so I think AI safety, broadly construed, should be a real priority. I'm biased, but
and let me interrupt you there to then say, what does that look like? Are you looking for heavy-handed regulatory measures and other forms of intervention?
So I don't know that. So I think some regulation is absolutely necessary. There's really bad abuses, things leading to bad mental health outcomes, leading to really bad content coming out of these models. So some regulation is absolutely necessary. I don't know that regulation is going to solve it. Maybe I think this is a big question, and I think we need to struggle with it. I think we need investment in this area of AI safety. We need companies who are actually putting this as their number one priority rather than profit or growth. So that would be my sense of it, but I think we're struggling with this right now.
Last question. So outline that path to a happy future, and what would that look like?
Well, I think the dream would be somehow that AI creates a more equitable world, right? Because somehow now, like we sort of had hopes with the internet that maybe these a disadvantaged person could very quickly come up to speed,
Yes.
very quickly learn all these things. I think that the AI does have this potential. I mean, it's really incredible if you just have access to one of these models, what you can learn if you're motivated. You have, I mean, the internet was one thing, but asking ChatGPT is a whole other thing. It's like having an expert right there in your house. So there is a lot of potential, but I think there are a lot of things to worry about, to struggle with. I think we'll get there. I am optimistic, but we have a period of struggle and change that we're in the midst of. It's exciting and a little bit terrifying.
I'm going to cover a couple of other subjects before we proceed with the other elements of our conference. Commercial space is a big subject on everybody's mind. The reason being, we're starting to work from home now more than we ever did historically, and so what is that looking like? And is there going to be a comeback in that sector? Well, let me start by telling you that there's not much construction. People read the tea leaves and they understand what's coming down the pike. And so construction has just fallen dramatically, as you can see. Projects that were already underway, obviously, those have been finished. No new starts. That's one way to understand this. Vacancy rates. This is the rate in Silicon Valley is 22%. That's a high percent. At the start of the century, we were around 5% vacancy. So we've climbed a steep mountain to get to here. However, we're also making a comeback. This is what it looks like when we compare ourselves to our peers around the country. And I was frankly surprised to see that we were so far down the list. You can see that we're at the bottom. You know where there's the most vacancy right now? It's up in Seattle. Interesting. San Francisco is still plotting their comeback, but they're growth positive in terms of lease activity, and then followed by Oakland, and then these other metros. But there's Silicon Valley actually making a pretty fast comeback. Our leasing activity has a characteristic that you might not see in other places. It's dominated by the big players, and this chart just shows you that you have these top 5 players, and they were just occupying the lion's share by far of all of the commercial space out there. That changed in approximately 2021, when suddenly a new model came to the fore. We're on efficiency kicks. We're not building big campuses anymore. We're not swashbuckling anymore. We are now cautious and conservative, and so just know that the big 5 and other tech companies are not renewing leases, they're not entering into construction, and they're actually repurposing real estate that they hold and subleasing it. All of those things are happening, which leads to remote work itself. We're trying to get objective measurements about remote work and what that means for our region. Let me tell you where we think we stand right now. Let's contrast that first to set up the comparison. This is 2021 at the height of the pandemic, and our region led the nation. We didn't just start working from home, we embraced it. We loved it. We thought that was our new normal, that we were just going to work from home for the foreseeable future. And so you can see San Francisco, San Jose are on the top of that chart. This, by the way, is the share of the workforce population who were only working from home. That's what this is measuring, not hybrid models, that type of thing. But this is in San Francisco in 2021, 35% of that workforce only worked at home. Okay, that's what that's saying. Now here we are 2 years later, and look what's happening. We actually peaked. Something happened at the tail end of the pandemic. The employer said, this has been fun, but we want you back. We want you back. And at that point, employees, especially the younger set, said, nah, we don't want to. We'll stay home if you don't mind. And this interesting power struggle ensued. And this is where we landed. We landed with the hybrid model. And that's 3 days a week. That's basically throughout the valley. That's what we're seeing now. I'm seeing heads nodding. I think that probably describes your experience as well. And so the share that were only working at home had fallen to 17% by 2023. And now here we are today. This is right now the most accurate information that we have. And this is the share that is working primarily from home, okay, right? This is not measuring hybrid workers, just people that only work at home. And the highest amounts are no longer in the Bay Area. It's Denver. Who knew? It's Portland, Seattle, Washington. Those are where we are. And then Silicon Valley's in the middle of the pack. In this county where we sit, 14% of the workforce is working only from home. So that's what's going on there. During the pandemic, we had the rise of people who had moved out of the region, but were still holding their Silicon Valley job. And they were doing it remotely. We tried to measure how many of those. The measurements are imprecise, but we did a count, and it was 18%. 18% of Silicon Valley's workforce was living somewhere else, Fresno, Truckee, Tahoe, and they were dialing in for their job. That share is falling now. By 2024, last reporting period, that's been cut in half. So most people are back. They're in the region, they're working, and they're working in hybrid models. We have surveys of employers. The best one is Bay Area Council's survey, which they do on a regular basis. And according to the Bay Area Council and their member companies, it's almost full coverage, full participation in the hybrid model. There are very few companies now that are saying work from home all the time. Very few companies that want you in the office 5 days a week. We've landed about here. This is a chart that's now showing you the share of time that you spend working from home. And that share is now translating to about 1.5 days a week. That's where we've landed. Or in other words, you're spending 31% of your work week at home. The other 69% you are in the office. And you can see the trend here. We used to be ahead of the blue circle is the national trend. We used to be ahead of that, but by 2025 we're just right in line with what's going on in the rest of the country. So that's how we should understand work from home. Okay, ladies and gentlemen, that concludes the morning's briefing on the economy.